What's up, guys? Today we're stalking some yield farming wallets and we're going to be looking at their profit and loss. Why are they losing money, or if they're making money? And a lot of these are losing money. I've specifically picked them to point out a few problems with their strategies, what to do instead, and hopefully that will help you form your own strategies as well. If you're new here, my name is Richard. I've been yield farming for quite a while now, and I have a pretty good track record, and my portfolio and my clients' portfolio do have pretty good track records. You can see here my open positions is sitting on 10.23 ETH of profit. My close position is sitting at roughly 7.7 ETH worth of profit. If you total it up, it's roughly 19 ETH, so not too shabby. And if you prefer other trackers like the Metrics Finance Pro tracker, you can see I'm beating imparent loss pretty comfortably. And since I'm doing that, I am able to retain a lot of the earnings I make because I'm beating just holding and beating Ethereum as well, which is the asset that I typically start with in a lot of these yield farming pools, while still averaging a nice 51% APR. If we scroll down here, you can see versus HODL, it's positive. And I personally don't like to use the US dollar value to track, especially when it comes to crypto pools. The reason why is it could show a positive number while I'm bleeding out Ethereum. If we look at this AI XBT pool here, I'm actually sitting at a loss, even though it's showing a positive US dollar value. If we hop back to revert, you can see I'm down roughly 0.37 ETH on my investment. So 13%, not too bad because the price has retraced quite a bit from my entry. I'll be staying in this pool because I believe it's going to bounce back eventually. But either way, I'm still beating holding these two tokens separately. So let's dive right in. A lot of portfolios actually look like this. They might be making a lot of fees. You can see their APR is quite high. So they're running pretty tight range strategies, and they're pairing these smaller cap altcoins with Ethereum like I am. Some of these are meme coins like Pepe, or AI coins like ATH or the World Token, and even larger caps like Link. But you can see here, they're actually losing a lot of their ETH in the process, and some positions are positive in terms of Ethereum. So when your portfolio looks like this, you might as well just be holding Ethereum, right? Because the fees you got doesn't cover like the divergence loss you're suffering in terms of Ethereum. If we click on Pepe and ETH pool, for example, you can see they earn 2.21 ETH in fees, and they're suffering a 2.7 ETH of divergence loss. So one thing I noticed about this portfolio is that they have 44 positions open. When you have that many positions open and you're not automating anything, you don't have a process in place, or you're running tight ranges like they are, they're typically spending tons of time managing these positions because they get knocked out of range all the time, right? The good thing is that they're more diversified if they have this many positions. But the bad thing, again, is that these pools get knocked out of range all the time, and their net APR might be much less than what is showing here. And if I add their exited position, they're at a very slight profit right now. But compared to holding, they're down massively, even though they generated so much fees, right? Almost $400,000. This portfolio right now is worth $1.3 million. So their strategy is definitely not working. They would have been better off just holding in the market and not even yield farm. They could have been just staking their Ethereum and make more profits than this. So this is definitely the case where you don't want to be in. Like if this is your portfolio, feel free to reach out to me. I just picked a random one that is in the same pool as I am. I basically clicked on this bonk pool and basically find like a very tight range strategy person. And this is the portfolio that I see. If I look here, and you can see here, this is their bonk pool. They're at a slight profit right now. But if you look at their whole portfolio, the strategy clearly isn't working. And you can see here, if I pull it up in Metrics Finance, they're pretty much down in all terms, right? US dollar terms versus HODL, even though the market has bounced back a little bit. So what would I do instead? So if I were in this position, what I would do instead, I would consolidate my positions a little bit, depending on how much time I have. If I'm a full-time yield farmer, managing 44 positions is not a big deal at all if that's all I do, especially if you guys run wider strategies like I do, which allows you to still earn a nice APR, but to actually retain all of the profits, right? When you're chasing ranges like they are, a lot of times you're going to be giving up a lot of your gains when you rebalance because you're locking in that impermanent loss. So that's the first thing, right? If it's too time consuming and you're not managing your positions properly because of that, you're not looking at their charts, then you want to consolidate your positions to maybe 10 to 15 if you have more time to manage. And I would also consider switching to a more wider range strategy because clearly the tighter range strategy is not working for them unless they have some sort of hedge in place, like if they're shorting or doing some other plans to basically hedge out their positions. But to be honest, looking at this wallet, it doesn't seem like they have a hedge in place because you have so many positions to manage. It's not very likely that they're able to run through like the hedges properly with this many positions because it is more time consuming to manage if you have a hedge in place. And again, guys, if you're taking a lot of risk and you're not even outperforming Ethereum, then you might as well just be holding Ethereum, right? Especially if you're farming a lot of these Ethereum-based pools. So just because you have, a lot of capital to yield farm with doesn't mean that the strategy is great. And if you're cash flowing a lot of money, but you're bleeding out your portfolio over time, your portfolio is just going to keep going less and less, right? Especially if you're spending those fees. So let's look at this next portfolio I found. Again, they're at a slight Ethereum loss on their open positions. So for this one, they're at a slight Ethereum loss on their open positions. If we add the exited pool, they're actually at a huge loss right now. And if we scroll down their pools here, they actually have pretty solid assets like Aave, ETH USDC. Clanker is more debatable, maybe a higher risk play they use to boost their APR. ETH and Link is pretty solid, but if we scroll down, you could see they're running a ETH to USDC pool. They deposit roughly 23 days ago, and you can see if you're running very tight ranges, especially for a crypto to stable pool, when the market doesn't move into your direction, you might as well just be holding Ethereum at that point. This is their ranges, 1559, and the top is $2,000. And because Ethereum pumped all the way up to 2553, they're down roughly 2.5 Ethereum if they were just to buy and hold Ethereum roughly 23 days ago. So down pretty horrendous. And typically, I don't really like to use crypto to stable pools when the prices are so cheap, precisely because of this reason. When Ethereum moves back up, your ETH and USDC in the pool is going to be fully converted to USDC, and you might as well just be holding Ethereum in the first place. You can see they have a very slight USDC profit. They deposited roughly $24,000 here, withdrew $24,500 something dollars. If you include the fee, this is the net profit, right? Versus just holding their asset, they're down pretty badly here. And again, guys, it's because they have a very tight range and they're using the wrong strategies in that particular market condition. I can't tell what the future is going to do, right? Ethereum could have just stayed in that price range for a long time. But generally, for me, when prices are cheap, I put most of my asset in crypto to crypto pools because I don't want to miss the upside. But in terms of asset selection, I think they're doing pretty decently well, except for maybe this Clanker ETH pool, but it's only a small portion of their portfolio, so that is fine. But at the same time, they have a pretty big position on this Aave and ETH pool. So if Aave doesn't do well, they could be at a lot of risk here. So 10 Ethereum out of their 34 Ethereum portfolio is quite a big position to place. If we look at Aave here, you can see it's ranked 31 right now in terms of market cap. So not too bad, at least it's a larger cap coin, but altcoin performance could be very volatile and we never know what's going to happen in the future, right? So personally for this portfolio, I would be diversifying my investment a little bit more. So the first portfolio, we had over diversification, right? On this portfolio, I would consider under diversification. Actually, they have more than 10 ETH. If we scroll down here, they have another 4.9 ETH in Ethereum to Aave. So if this is their only wallet, that's a quite heavy exposure to Aave. So that's it for this portfolio. And the second thing, again, you don't want to run too many ETH to USDC pool, especially tight ranges one when the prices are so cheap. Let's look at this next wallet. Right now, they're sitting at a slight Ethereum profit. So that's nice to see. But again, if you add their exited position, they're down pretty badly here. So if we look at the asset they pick, it's pretty solid. Pendle USDT, Wrap Bitcoin USDC, ETH and Aave. So nothing too crazy here. A lot of DeFi pools. So for this wallet, I really want to dive into their Pendle positions here because I actually am bullish on Pendle. I've made profits on my Pendle to ETH pool before. If you could see here, if we go back to my closed position here, I made 1 Ethereum profit on this Pendle to ETH pool. I'm still waiting a little bit to re-enter into this pool because I've already deployed a lot of my capital already. But if we filter their wallet with just Pendle here, that's what you guys can do also with Revert Finance. Just go to filter here, pick the token that you want. So let's first look at Pendle to ETH pools. Their Pendle to ETH pool right now, the open one is sitting at a slight positive, but you can see they actually close a lot of their positions for a loss. Meanwhile, I closed my position for a 1 ETH profit, right? So in this case, the asset selection is not the problem. It's the position management and likely the entry. So they actually entered Pendle to ETH at a pretty high price here, and then they exit the pool at a lower price. That's why you see a negative Ethereum loss. So that's their first position, and let's see what they do next. So they rebalance down their positions a little bit by dragging down their bottom range here from 0.001829 to 0.00174033. And the max range is still roughly at the same price, slightly down. So they rebalance down a bit. And then again, it exited their bottom range again. So they are forced to rebalance again. So right here, they're chasing the range here with the min price 0.00158 and the max price 0.001859. So once again, locking in that impermanent loss. And then here, they lowered their bottom range again, and the max price is at 0.00177. So this is like the really quick way to lose your Ethereum while you're yield farming. I'll show you guys the chart and explain why. So this is actually my old position. I entered roughly here on the green line, and then I exited roughly at this current price to rotate into other positions. But you can see my range was pretty wide here versus their range. What they were doing was basically this, right? Roughly 0.002, and then the bottom range is 0.0018. Then they moved it to 0.017 because the price kind of moved down a little bit. And then they're knocked out of range again. Now they're rebalancing to a very tight range here. So when you rebalance down like that, of course, you're going to be capturing a higher APR. But if the pool exits more on the downside, you're going to be fully in Pendle and you're going to suffer more Ethereum loss. So that's the big downside of it. And if it rips back up on the upside, you're going to miss out a lot of the gains as well because your Pendle is going to be converted to Ethereum very quickly here at this average price. So more downside and then also less upside in exchange for fees. In my experience, this is never worth it, especially if you keep chasing down and down and down until like this range, and then it rips back up again, right? And you basically locked in a lot of losses, sold a lot of your Pendle for cheap to chase the range. And then when it rips back up again, you lose a lot of money. So that's what you want to avoid at all costs. And it seems like that's what they're doing right now. I actually didn't look at this wallet too much before I dived in. But after I dived in, it's pretty clearly here. They're probably chasing the range for a lot of their pools. If you change the filter to Pendle and USDT, you could probably see something similar here. So they were providing liquidity since like Pendle was trading at $5 to $6, and they probably chased the range all the way down to the current price at the $3.5 to $4.5. So this strategy doesn't make sense at all, in my opinion. you're going to lose a lot of your ETH and even your USDT when you do this. But you can see they're getting a very high APR. And again, it doesn't matter, right, guys? In total, they generated 13.5 Ethereum in terms of fees, but they're down like 12.39 Ethereum in terms of total profit. And if you keep doing that, this whatever ETH they have left, like 48, 49 ETH, it's just going to keep trending to zero. And same thing with this larger wallet that we looked at before. They generated a crazy amount of fees, 150 Ethereum in terms of fees, but they retained basically none of it, right? Their total profit is like 0.353. So now let's look at a slightly profitable wallet and see what they're doing right instead of these other wallets. So they're sitting in pretty nice profit here, but it's mainly from this single position that they have opened rather than their overall strategy. So if we add their exited positions, again, they generated a crazy amount of fees, 37 Ethereum in terms of fees. So likely they were running pretty tight ranges beforehand, and their total profit is only roughly 2.93 Ethereum. You can see here, if you take away their recent position, minus 7 Ethereum, their overall strategy is down 4 Ethereum on their old closed positions. So they actually have a wider range than most people, but in my opinion, the range is still not wide enough. You can see it's very easy for them to get knocked out of range. For me personally, I like to look at the weekly chart and try to capture at least 6 to 12 months of price action. And with this person, they deposited a lot of funds. And when the position touched like their bottom range, they decide to exit the pool and maybe rebalance the pool a little bit. So a lot of times when this happens, you actually don't need to rebalance too quickly here. And it seems like that's what they did. They rebalance this position into this position with a tighter range, likely to get more fees. So a little bit of range chasing here. But as you can see, this strategy never works. It often comes with more and more losses. And finally, they went into a wider range here. So when they finally stuck with a wider range, they're actually able to become profitable in terms of Ethereum rather than being at a loss, right? So this is precisely why I prefer wider ranges compared to tighter ranges. It's going to be much easier for you to retain the profits, even though on paper, the APR is not as high, right? I see people advertise like, 100% APR, 300%, 1,000% APR all the time, but the actual earnings that they could retain and take out without like basically bleeding out their portfolio is actually much less, because the only way to get like really high APRs, especially on like blue chip assets, it's through like squeezing the range, right? And when you squeeze the range, again, it's very likely that you'll be losing the money rather than just, making more gains, right? Crypto assets are very volatile, especially altcoins. So it doesn't make sense at all to keep like a very narrow range. So it's great that this person, I don't know, finally switched to a wider range strategy and have a longer term mindset with their yield farming strategy. But if this is their only wallet and Link doesn't do well against Ethereum, or if Ethereum doesn't do well, then their portfolio would be in trouble here because they only have one positions, right? They have a good amount of funds. If we look at the US dollar value here, roughly, over 6 figures in one single position, that's a very high risk strategy versus having at least 5 to 10 positions on the assets that are solid or on assets that you are bullish on. So compare against holding, this position is doing quite well because the range is a bit wider in terms of ETH profit, which it makes sense to measure it on, is doing quite well. But again, if you look at their previous strategies, it was doing pretty bad compared against holding. They're down $40,000. So they might as well just be holding the assets they yield farm with, right? Now let's look at another wallet here. Again, this is running an ETH to Link pool as well. Same problem as this other wallet. It's not adequately diversified. You only have like one position. And if this is like your only position, then you're taking a much higher risk compared to having a more diversified approach. So again, higher APR on paper, add exited pool, down pretty badly here, have 5.3 ETH in fees, but their total P&L is down roughly 6.48 Ethereum. And once again, if you're underperforming Ethereum with these pools, you might as well just be holding and staking Ethereum rather than spending a lot of time to manage and yield farm these positions. So this looks like a test position here that they put in 112 days back. But let's look at this next position. So a relatively tight range strategy, again, deposit it and end up withdrawing when the prices are low. And let's see what they do next. So this person, once again, is chasing ranges. The min range, right? You can see the min and max price here. They moved it both down. And this is like really bad, right? Because if the market again rebounds, then you're going to be losing a lot of money. So again, for this person in particular, it would have been much better off just sticking with wider ranges. So if we draw like the parallel between these wallets, you can see a lot of these wallets suffer from one main thing is that they're running very tight range strategies. And another mistake we saw is over diversification. You have like 44 positions open, right? It's very likely that you're not keeping up with the charts, taking profits when you need to, or reinvesting your fees in an optimal way when you're doing that. And we also saw using the wrong strategy at the wrong time, like farming a lot of ETH and USDC pool when prices are cheap, especially with tighter ranges, which could cause you to underperform Ethereum pretty significantly here and miss out on a lot of the upside. Again, some people are basically providing the liquidity in the same pool as I am with like Pendle and ETH or Pendle and USDT. But because the strategy is not that sound and the execution of it matters, right? Just because you have the same assets doesn't mean that you're going to make a profit from it. If you mismanage your positions or if the strategy doesn't make sense, then you could be at a net loss. And maybe it's not the complete picture here. Maybe this person has like some sort of hedge in place for this Pendle and USDT pool. Maybe they're at a profit. But a lot of times when I look at hedge strategies as well, these people lose money, especially if they're running very tight ranges. And we do begin to see improved performance when they switch to like a wider range strategy. And again, if you're not outperforming Ethereum, then you might as well just be holding Ethereum in the first place. Or if you're underperforming holding in the market, then you might as well just be holding the tokens you deposited in the pools in the first place. Because the fees doesn't matter if you're significantly underperforming these metrics. And we also talked about not having enough positions to diversify your assets. If this is your whole portfolio in one position, then when something goes wrong, it's very likely that you could lose a lot of money. So our goal again here is to make a net profit. I am currently still following an ETH accumulation strategy. And when Ethereum is trading above $3,000, I'm going to be shifting more and more in terms of locking in more US dollar profit. So this is our goal, right? To make a US dollar profit and Ethereum profit over the long term, as well as beating impermanent loss as a secondary metric. But really, my goal is to make a net profit. Even if I underperform just holding in the market a little bit, I don't mind, as long as I end up with more assets than what I started out with. So I hope this video was valuable for you guys. You know, there are a lot of things that could go wrong when you yield farm with concentrated liquidity pools. A lot of the wallets I find online is either at a very slight profit or at a huge net loss because they're either following the wrong strategies or using the right strategies, but in the wrong market condition, right? So be sure to check out my videos if you want to learn more about yield farming and how I'm able to create a profitable process. There's a lot of free videos on my channel already, and I am putting together a course because a lot of people have been asking me about it. That's basically going to share you like everything I know about concentrated liquidity pools, right? And I do want to share you guys like the client portfolio I have here before we hop off. So this is the current open positions, and tracking like a more diversified approach of this portfolio could be more complex than what we just saw. A lot of the portfolios we just saw was running only Ethereum based pools, but here our goal is pretty dynamic For example, for this ETH to USDC pool, our goal is to actually accumulate more USDC and use that to basically de-risk up into the market. The initial investment for this particular pool is $50,000. You can see it's up roughly $13,000 right now, and it's only been in range for 42 days. But if we measure the ETH profit and loss, then it's down a little bit in terms of Ethereum. We don't mind it in this case since we're trying to accumulate USDC on the way up with this particular pool. But if you look at these other pools here, in nice Ethereum profit, slightly down on this Arrow and ETH pool because Arrow is trading slightly below our entry, but this is a blue chip focused portfolio. If we look at the closed positions here, you can see the net gain of Ethereum is quite large at 11.49 Ethereum. If we total that up, sitting roughly at 10 Ethereum profit, even with this USD accumulation strategy. If we take this out, we're actually at more than a 12 Ethereum profit overall. And this portfolio basically started like the March of last year. So doing quite good, especially when they entered the market when Ethereum was at roughly $3,300. Now Ethereum is trading at $2,500. So their portfolio is up pretty nicely here. Again, guys, the strategies that I show you guys definitely work for me and my clients. It's not just something that, I put together on the fly and haven't been proven, right? Thank you guys for watching. I hope we make a lot more money yield farming together. I'll catch you guys on the next video.